Most people who are getting in real estate for the first time are focused on cash flow. If I can buy myself 10 single family rentals that will cash flow $500 a month, then I'll be making $5,000 a month and I can retire. Here's the reality. Appreciation made more millionaires than cash flow uh, throughout real estate history. Cash flow really is what keeps you alive while appreciation does its work. That's the reality. And I learned that lesson very early on. I realized that it's not really a cash flow play. It is appreciation.
Quick favor before we jump in. It always surprised me that a large percentage of people who listen to the show regularly haven't yet subscribed. If you're a commercial real estate operator, investor, or builder who values conversations like this around deals, capital, and technology, please take 2 seconds and hit subscribe. It's a simple free way to support the show. My commitment to you is that my team and I will continue bringing you higher level operators, stronger conversations, and real execution level insights every single week. Thank you. I truly appreciate it. Welcome back to the AI Edge podcast, where we sit down with operators, investors, and builders who are making real decisions in commercial real estate and thinking clearly about systems, execution, and long-term leverage. Today, we're talking about the power of pivot, how someone goes from a traditional career into commercial real estate, and what it actually takes to build disciplined investment track record without turning your life into chaos. My guest today is Neil Henderson, general partner at Nomad Capital. Neil spent 18 years as a defense contractor supporting war fighting in the United States Air Force, then caught the real estate bug, built an active portfolio, and eventually moved into the world of commercial real estate syndications with a strong focus on self-storage. Since joining Nomad Capital, Neil has helped raise more than $11 million in equity from passive investors, who has contributed to building a portfolio of stabilized storage assets under management across multiple states. Neil, welcome to the show.
Thanks for having me, Lewis. I'm happy to be here.
Great to have you, Neil. So let's start off with your story. You spent nearly 2 decades in defense contracting, then made a major pivot into real estate. What was happening in your life or the mindset that made you start looking in a different path?
Oh goodness. Let me lay down on the therapist couch here for a second, Lewis. My job as a defense contractor was fantastic. I loved it. I started working uh, in defense a little bit before 2000 September 11th, 2001. We don't need to go into this background, but I was an actor previously. I started doing classified voiceover, got a security clearance. Had a security clearance on September 11th. Suddenly that became incredibly valuable. The acting gig wasn't really working for me. Had a chance to move back to my hometown, Las Vegas, and join a defense contracting company and learn on the job, because there was such a backlog for security clearances at the time. It was easier for that company to hire me and let me learn on the job than it was to hire somebody who knew how to do the job and then, get them a security clearance at the time. Very exciting. Really felt like I was helping the warfighter during a time where the ops tempo was very high. We had 2 wars going on. I was doing my part to help train United States and coalition air crews on how to fly and fight their airframes. And it was fantastic. As the ops tempo started to kind of wind down, things just got a little slower. The security around data security started amping up a lot, thanks to Edward Snowden, Chelsea Manning, things like that. And so a lot of the work that I was doing became harder and harder to do. I was using software packages that required connections to the internet. And the Defense Department information technology people are not real, especially when it comes to classified. They don't like that. It's very hard to navigate around that. It just became harder and harder for me to do my job. It got to a point where I started seeing, it's like, I don't think I can do this for another 20 years. Not like this, as much as I had loved it. During that time, I had kind of gotten the real estate bug. We had bought a house in Las Vegas in 2013, had a little guest house at the front of it, converted that into a short-term rental. We're very successful in that. That's kind of what gave me the real estate bug. And started digging into real estate, I tried every different strategy under the sun, buried myself in the Bigger Pockets podcast, Eventually, ended up buying some long-term rentals in Fayetteville, North Carolina in 2017. I got exposed to self-storage and learned about commercial real estate and really tried to kind of leapfrog all of the normal steps that you would take into commercial real estate. I kind of tried to skip most of the single family rentals and small multifamily and then getting into commercial. I started raising some capital for some multifamily syndications, met my now business partner Eric Hemingway at a commercial real estate conference in 2017, started trying to make a go of it in self-storage on my own. And I was living in Las Vegas at the time. Las Vegas is a very difficult market for a new self-storage investor, active investor to break into. It's kind of a primary market. It's kind of on an island. So it's not like there's any little secondary, tertiary markets around the area that you could maybe go and buy a smaller facility and learn. So I really beat my head against the wall for a number of years, but constantly stayed in contact with Eric and was following his journey as he, as an active self-storage investor, started leveling up his game. I kept on telling him, "Hey, Eric, you really need to syndicate. You need to bring in other capital." And he was very patient. He's like, "Nope, I'm not ready. I want to prove our concept, build up a portfolio of assets that can sustain us if we start taking on other people's money, if something goes wrong." And eventually moved out to, left my job in September of 2021 and moved out to North Carolina where where Eric was based. Nomad was formed in October of 21. I moved here at that same time, bought a house in Carolina Beach, North Carolina, and been here ever since.
What did you learn in your defense contractor years that actually transferred into real estate? What is it? Discipline, planning, operating under constraints?
That's a great question, Lewis. Often get called the compliance officer in our building. When you're raising investor capital, you're operating under the SEC guidelines and they have very clear rules. And sometimes, I work in a building full of entrepreneurs who want to go fast and break stuff. And sometimes I have to say, guys, that sounds great, but we need to clear that with our SEC attorney before we can do that. And sometimes we find out, yeah, you can't do that. So that's one thing. I operated under a high security environment, and there's just things you can't do. Second was my primary job as a defense contractor was education and multimedia education. It's kind of how I learned how to be a podcaster. We were doing a lot of video voiceover work, things like that. And I learned how to essentially educate people on whatever complex subject we were trying to educate them on. And that's often sort of how I view myself. I'm not a sales guy. I'm an educator and I'm an advisor. And so that's often how I approach things when it comes to dealing with investors. I'm not here to sell them on something. I'm just here to educate them on how self-storage works, how commercial real estate works, and then find out what it is that they're trying to accomplish and find out whether or not I can advise them on whether or not what they're trying to achieve aligns with what we're doing. And oftentimes it's not. And we have to tell people, hey, listen, that's great. I know you're excited about what we're doing, but we're not a good fit for you. Based on what you're telling me, what you're trying to.
I love that, Neil. Being an educator, what did real estate teach you that your previous career did not?
Oh, goodness. Well, I went from a pretty stable career. I probably could have gone off and made more money working in other industries during the 2000s. I was insulated in many ways from some of the economic shocks that happened during the 2000s because I was a defense contractor. And I've had to learn to be a lot more disciplined with my money because I went, September of 2001 was the last time I got a steady paycheck. And I've been essentially without a steady paycheck since that time. I make a little bit of money on our acquisition fees. I'm not living high on the hog at all. We don't really make money until our investors make money. And that's usually either after we've paid down their pref and we're cash flowing, or we have an exit where we're able to, pay off the investors. So it's taught me that the lower that you can keep your living expenses, the more optionality you have. I have friends of mine in this industry who are really struggling right now because they entered this industry from a background where they were making $300,000 a year and their lifestyle had grown to that point. And then they went off to be an entrepreneur and suddenly they're not making $300,000 a year and their lifestyle, it makes it really, it can make it so that you can make some bad decisions about money because you're not able to be patient. You have to, if you have to get paid right now. I can afford to be patient. And I think that makes my decisions around money a little smarter.
That's beautiful. You summarized your career journey in one word, Neil, and it is pivot. So when you say pivot, do you mean reinvention, adaptation, or just willingness to change course quickly when you learn something new?
It's a great question. I would describe it more as I've pivoted, made major pivots in my life twice. I was a struggling actor in the 90s, and then I pivoted to becoming a defense contractor. Does not sound like a natural fit. Anybody who hears that, it's not. And then I pivoted from defense contracting into full-time commercial real estate. I would say that oftentimes when we are in a comfortable but not perfect situation in our career, you often get complacent and you're afraid to pivot because you think about all of the bad things that could happen. And I let that mindset constrain me both times before I pivoted, but especially before I pivoted to commercial real estate, entrepreneurship. And I remember an advisor of mine, when I was talking about the things that I really wanted to do, finally said, what are you What are you afraid of? What are you waiting for? Like you keep telling me about all the bad things that can happen. What are the good things that could happen? And I'm not going to say that it's been sunshine and rainbows since 2001. It absolutely has not. But I've never been happier. And I love the people I work with. I love what I'm doing. And I'll take this advice from my dearly departed dad till the day I die, which is if you love what you do, you'll never work a day in your life. And that's very much what guided him through most of his career. And he worked pretty much up until the day he died and would not tell you that he regretted it for a second. He loved it.
That's beautiful, Neil. What do people get wrong about pivoting, especially when they look at it from the outside?
That it's easy. It's not easy. The things that are hard about it are going to make you a better person. Like I said, I've been essentially without a paycheck since 2021, September of 2021. And that's made me more disciplined about my money, just the day-to-day finances, made me more disciplined about my investments. And I think that you need to, if you're going to pivot, you need to have some runway. I was fortunate to benefit from a bull market in real estate in Las Vegas when I bought my property in 2013. We had that short-term rental at the front of that property that was paying a lot of our mortgage and plus, and we were actually able to pay down that mortgage quicker. So we had a huge amount of equity. So that's really what allowed me to make that leap, to make that pivot. And I've largely been living off of that nest egg since then. So I would just say that, you don't be afraid to pivot, but don't do it foolhardily.
From somebody who has pivoted many times in his career also, how do you know when it's the right time to pivot versus when it's time to just stay the course and push through it?
I would say that if you find yourself sitting at your desk doing whatever it is that you're doing and you're thinking more about what you want to pivot to than you are in the day-to-day work that you're doing, it's probably time to think about pivoting. You're not doing yourself any favors and you're not doing the people that you're working with any favors. Yeah, that's my answer.
That's fantastic. You started with short-term rentals and single-family rentals. Then you realized the limitations of being an active landlord and moved towards passive investing and syndications. What was the moment where you realized this is not scalable for the life that I want?
Oh, it was very early on. I was meeting other investors. I was going to RIA meetings. I first tried to figure out how to scale my short-term rental business. And I had a conversation with another one of my now business partners, Clint Harris, who owned, I think, 14 short-term rentals and then started a management company where he managed another 50. And he told me that he's like, you know what? I have built financial independence, but I have not built time or location independence. I've just basically built myself another job. Um, it was also watching the way that, people were, you know, most people who are in getting in real estate for the first time are focused on cash flow. If I can buy myself 10 single family rentals that will cash flow $500 a month, then I'll be making $5,000 a month and I can retire. Well, here's the reality. Appreciation made more millionaires than cash flow uh, throughout real estate history. Cash flow really is what keeps you alive while appreciation does its work. That's the reality. And I learned that lesson very early on. I realized that it's not really a cash flow play, it is appreciation. Now, the other caveat is that you can't count on appreciation. But in commercial real estate, you kind of can because of the dials that you can tool, because the value of a commercial real estate asset is based on the amount of money it makes, not what the price per square foot of the comp of the built, property down the street sold for. And so you can it's a very mathematically oriented. And I can tell you why the value of a commercial real estate asset increased in value based on its NOI and its cap rate. I can't tell you why the value of Apple computers stock went up this much. As much I invest in the stock market and I love Apple and I love, there's lots of different companies that I own. I can't tell you why Apple is going to be worth more in 5 years than it is now, or why it's going to be worth less. But I can tell you why a multifamily property is worth less today than it was 3 years ago. And that's really what the breakthrough for me.
Numbers don't lie.
Numbers don't lie.
What appealed to you about syndication model from a time and systems standpoint?
Well, again, it's just when you're syndicating, if you really think about it, the only truly passive real estate investment that you can make is in a REIT or a syndication. And even a syndication requires a little bit of work. You're going to have to vet the operator. You need to know a little bit about what it is you're doing, but you really are, I often say that in order to be successful in real estate, you need a combination of these three things: time, experience, and money. Well, most people have money, but they don't have the time. And if without the time, they can't gain the experience. And we love anybody who's in real estate, we love leverage. And so in syndication, what you're doing as a passive investor, you're leveraging the time and experience of a professional operator. And the operator is leveraging your money and the bank's money to make us all more money. And that's really what I loved about it. And I got it. And combine that with the mathematical approach to commercial real estate. And I just got it. It really clicked for me.
Where do syndications go wrong?
You often have syndicators. We've been in a bull market in real estate we were probably in a bull market from about 2010 to 2021. And I think a lot of people got into syndication before they had proved themselves as an operator. And I think you're seeing that shake out a lot. There's a lot of people who got into multifamily syndication and they had never really done it with their own money. And it's one of the things I respect so much about my partners, Eric and Levi Hemingway, is they were very slow to come in and start taking other people's money before they had proved the model with their own money. And I think a lot of syndicators were like, oh, this is easy, man. I just come in, I just buy a multifamily I just talk to a bunch of rich friends or and friends of friends and go out on social media and talk about investing in multifamily. And we go out and we buy this 800, 500 unit apartment building. And this is easy. It's not easy. And I can tell you that right now, there's some really experienced multifamily operators, even right now, that are getting killed because of what the market did. And if they're having problems, imagine what's happening to somebody who really hasn't been through a lot of multifamily, real estate cycles. Those are the ones that are having total losses. And it's a sad thing to see. And it's making it hard for all real estate syndicators because the buzz out there among the retail investor is, well, commercial real estate's bad right now.
Unfortunately. Let's talk a little bit about self storage. Why self storage? So you're direct about self storage as a focus. Why self storage, and why do you believe is such a strong lane for busy professionals and operators?
Yeah. So first, let's talk about commercial real estate. You've got multifamily, you've got, I often tell people, like, look, there are these assets that you drive by every day. You drive by a big multifamily building, a retail shopping center, a self-storage facility, an office building. You often think to yourself, I wonder who owns those. And the truth is, people like you. And it's generally in some sort of syndication. Multifamily, people always need a place to live, but you're still dealing with tenants, trash, and toilets. And you're going to have about 50% of your expenses, not including your debt service, they're going to go towards the bottom line. You're not going to get that. With self-storage, you don't have tenants, you don't have trash, and you don't have toilets. You've got electricity. Oftentimes, self-storage operators have gotten smart. They don't even have light bulbs, light fixtures in the actual units. They're just outside the units, so you can't access them. Why? Because what we've learned over the years is people unscrew the bulbs, they'll put in an adapter, and they'll live in the units. Sad state of affairs, but it happens. Self-storage is it's a really simple business model. You're renting people a box of air. It's month to month. It's very recession resilient. It's not recession proof. It's, one of the first times I ever heard somebody talk about self-storage was saying, oh, it's recession proof. It's not recession proof. It's recession resilient because it's a trauma and transition business. In bad times, people are moving around, they're downsizing, they're moving to new locations. And when people are moving, they use storage. And then when times are good, people are renovating their houses. They're also moving. They're moving into bigger houses. They're changing jobs, things like that. They have toys that they maybe don't have room for, and so they also use storage. So it's kind of like you get the kind of good and bad times. It's recession resilient because among all the commercial real estate asset classes, it's the only one that can change its prices month to month. The only one that can do it faster is hotel and leisure. They can literally do it every night, and so anybody who has been a self-storage customer knows this. You're going to move in. You're going to be just coming in at a certain rate, and within 3 to 9 months, they're going to raise your rates. It's going to be about 10%, maybe, could be higher, depending on what their demand in the market is. And we know from data that generally people are not going to see that as a big enough price shock to make them want to go and rent a U-Haul, come there, maybe hire movers or move it themselves and move it into a new self-storage facility down the street that's just going to do the same thing to them. So it's really that's what I started when I started looking at commercial real estate, and I started looking at the kinds of assets that I thought had good demographic tailwinds behind them. Multifamily, I still think multifamily has some great tailwinds behind it. Assisted living, again, I will invest in assisted living. I don't want to be an operator myself because I don't want to be in charge of grandma. And self-storage. And so when I started looking at asset classes to go in, that was just the simplest one for me to go into.
Well, there's some of the misconceptions that people have about storage, especially those coming from multifamily or residential.
That it's passive. As an operator, that you can get passive. And I, respectfully disagree with a lot of the self-storage gurus out there who are sort of pitching it as a passive investment. It's not at all. I can tell you, we don't do what we're doing in this building here in Wilmington, North Carolina is not a hobby. It is not passive. And if you are a phenomenal person at operations and building systems, you can maybe take a self-storage facility and make it generally passive. I have a pretty good friend of mine who owns, I think, about 12 or 13 facilities. It's mostly passive, but he still has to go and visit those every day. He still has to pick up the phone every once in a while. It's not passive. And I think that's oftentimes what people think, that it's going to be a lot more passive than it is. It's not passive.
Neil, what would you say is the actual risk in storage that most people miss?
Well, the biggest enemy of self-storage is more self-storage. You're a self-storage owner. You're an operator. When all of a sudden, you're maybe full, you've got a stabilized facility, and all of a sudden U-Haul drops 100,000 square feet of self-storage, half a mile away from you. It's going to give you pause. So there's oftentimes we've seen it where there are some new self storage operators that come in that don't do their due diligence about the market. Self storage is a very localized market. You're talking a 1, 3, and 5 mile radius that people are generally going to be willing to drive to store their stuff. And so oftentimes people are like, God, why, what do you need another self storage facility? It seems like they're popping up everywhere. Car washes and self storage facilities. Well, if those operators are doing their due diligence, there's a reason they're building another self-storage facility there. It used to be, I think the numbers were, it was like 9% of all Americans were utilizing self-storage about 5 years ago. Now that's up to almost 13%. So there's a reason you're seeing more self-storage. But there are areas where there are just operators who just weren't really digging in. A bunch of operators all at the same time saw a good market, an undersupplied market, and they all moved in at the same time. And all of a sudden it went from an undersupplied market to an oversupplied market. Yeah, that's what I'd say.
Let's talk a little bit about Nomad Capital. Nomad Capital has a distinctive model, including conversions, development, and more vertically integrated approach. From your seat, what is the real operating edge in the Nomad model?
I have to say, our superpower, our secret weapon is our construction team. We're our own operators. Um, we we have a building literally behind this wall right here is a team of construction supervisors and managers who manage our deals. The reason we like conversions is because our last 6 deals we've acquired and built out these self-storage facilities for about $65 a square foot. That includes the price of the land, the conversion, everything. We also average about 12 to 15 months from the time we acquire it to the time that we open with a CO. Right now, in self-storage development, it costs you about $120 to $140 a square foot to build your garden variety self-storage facility. It can be a lot more if you're building a really Class A facility. And that doesn't include the price of the land. And the average time from acquiring the land to CO right now is 2 years and 10 months. And that really kills a lot of deals right now with the cost of construction, the cost of debt, because that entire time that you go from acquisition to CO, you're burning through interest reserves, you're burning through interest only periods, depending on how you've structured your deal. And so time, it's not just, I can point at our low cost basis, $65 a square foot, and thump our chest and say that's really what makes a difference. But I'll say more than anything, it's the time. And because we have our construction team under roof, when we need to make a change order with something, and there's always problems, there's always changes when you're converting an old Kmart into a self-storage facility. We can just go literally down the hall and say, hey, we need this changed. And the change is done within a week. Whereas if you were hiring an outside construction firm, that could delay you a month. And time is very much money in this case.
Why pick the conversion model?
Right now, that's what we love because that's where we're seeing the opportunity. And like I said, the cost basis and time. We have done operational turnaround. We've bought existing facilities that were nearly stabilized or almost stabilized and expanded them. We've built from the ground up. Right now, the opportunity we really see is in conversions. This year, we're starting to see more opportunity in some operational turnaround. There was a real gap in seller and buyer sentiment coming out of COVID because COVID created such a boom for self-storage. And there was a lot of self-storage owners who were able to sell at sky-high valuations. And then the interest rates shot up, and it took a while for some of those sellers that didn't sell during that period to sort of come to grips with their facilities were not worth what they used to be. It was during that boom market. So we're seeing some opportunity there. We are having some ground up deals sort of cross our desk now. I'm not saying we're not going to do them. It's just a lot of people have bought land back in 2022 that were maybe hoping to turn that into self-storage. They've gotten it entitled and they've been holding it for a long time. Now they can't afford to develop that on their own. And so we're seeing some opportunity there. So I'm not saying we're strictly conversions. That's been kind of what we've been doing the last 3 years because that's where the opportunity's been.
How does conversion strategy change underwriting, timelines, and risk management?
Well, you really have to know what you're doing from a construction standpoint because you're taking an existing building. I'll say one of the biggest challenges that we have faced on some of our conversions is fire and safety. You've got these old sprinkler systems that have been there, you don't know how long. You may know they could have been there for 30 years since the building was opened. And oftentimes, when you're converting it to self storage, sometimes the city will come in, the fire marshal will come in and say, no, you need to redo this. And you redo it. And then suddenly, you have a problem with now the existing water main line is maybe not sufficient to feed that new fire suppression system. And so that could have really, that's been something that's bitten us a couple of times. I'd say there's 2 or 3 deals where that's been a challenge that's delayed us. We get better at that every time. We now oftentimes engage the fire marshals very early on, learned that lesson. And that was what was the second part of your question? Underwriting.
Underwriting.
Uh, we say underwriting wise, storage for years has leased up at about 3% per year. It was like regular as clockwork. If you were in a market that was even reasonably healthy, you could count on about 3% per year, which means that if you have an empty facility on day one, it's probably going to take you about 30 months to lease up to stabilization. Well, we hit, when the interest rates shot up, that froze the housing market. And suddenly self storage was leasing up. We saw things leasing up at about 1% per month. And we had to shift our underwriting. Like, listen, this is going to take us a lot longer to underwrite. We're in the process now. I mean, things have gotten better. We're starting to see the market's kind of normalizing. We're starting to see some of those 3%, 4% per month return. But we've had to kind of shift on, all right, how do we do our deals in such a way that we're not bringing in investors? We're not bringing in one type of investor for the life of the deal. Because, we bring somebody in at an 8% pref and we promise them a 17 to 20% IRR on the life of the deal. Well, now it takes us 5 years to get to stabilization. That means that person is sitting there waiting on cash flow for a long time. And so a lot of times what we're examining is, all right, how do we break our deals up into different phases? Let's do a construction phase. And that's a very different investor. It's a little higher risk profile. They get their money back faster and then transition into, a lease up phase. That's a different investor. You're going to be a shorter period to cash flow. And then now, all right, well, now we get a stabilized facility. It's all right. Are you willing to just make 8% per month cash flow, with no upside? And that's a very different kind of investor. And so that's kind of how we're changing. We're examining our model right.
Neil, what does operational excellence look like in storage? Specifically, revenue management, marketing, unit mix, security, staffing, delinquency.
All of the above. We recognized that we were not necessarily as good at self-storage management as we thought we were. Eric had 4 facilities on his own that bootstrapped, and he was managing on his own with a team of people. And as we started to build that portfolio, and to be fair, the self-storage market changed and became a lot more challenging. So we went out and we hired a rock star, Cindy Ashby. She was the VP of operations at Prime Storage, took them from 30 stores to 120 stores in 3 years. And we brought her on, and it's been night and day, all of the above, from marketing to operations to occupancy management to revenue management, to security, to cleanliness of facilities. I mean, it's just, there's so many things you don't think about. I did say it's a fairly simple business model, but the devil is in the details. And I think we really had to have somebody come in to point out some of the details that we were missing.
Shout out to Cindy.
Shout out to Cindy. She's a rock star.
When deals go sideways in storage, Neil, what usually causes it?
Usually oversupply. And running out of runway. A lot of operators built or bought during the peak. COVID had a huge peak in demand during COVID because everybody was, there was a ton of people moving. There were people moving into home offices, converting bedrooms into home offices. They were storing stuff. They had converting spare bedrooms into homeschool rooms because they're homeschooling their kids. It was a boom for self storage. And a lot of people just flooded into self storage. And so there are some markets that got oversupplied. There were, you like I alluded to, is that the timing, when you're building a self-storage from the ground up, you've got a loan and they're typically going to loan you interest reserves that are going to take you through the construction and lease up phase. They're going to give you an interest only period that's going to take you through construction and lease up phase. And like I said, the timing, if you get delays on construction, that means you're burning through those interest reserves and you're burning through that interest only period. And then suddenly, all right, you open it certificate of occupancy. Well, now you've only got 6 months of interest reserve left and you've only got 6 months of interest only period. Well, now suddenly you're going to be paying principal and interest on top of you've run out of runway. And if you don't have sufficient reserves to be feeding that, and we've had to do that, we've had to feed some projects with our own money because you've been delayed in opening and things are not leasing up as fast as you expected. That can get you in trouble in a real hurry. And some of um, the deals that we've been seeing with operators that are in trouble, that's kind of what's happened to them, is they've just run out of their reserves, they've run out of the interest reserves, and they've run out of runway with the bank.
Love that, Neil. Let's talk a little bit about raising capital. You've helped raise significant amount of equity. What have you learned about investor communication and trust, especially when market conditions are uncertain?
Yeah. So, never going to get somebody to invest with you unless they know, like, and trust you. And our early investors were people who knew us. So they already liked us. They already trusted us. And then we've raised roughly 13.5 million from our own personal friends and family.
Amazing.
People who knew us before we were ever asking them for money. And then you go beyond that circle. Now you're kind of going into the circle of maybe their friends and their family. And you need to build that, they need to get to know you. They need to like you, and they need to learn to trust you. And oftentimes what we're doing is, like I alluded to, is I'm an educator. I try to educate them and advise them without the expectation that they're going to invest. I'm going to tell them all of this, whether that they invest with me or not. And I'll tell people flat out, hey, listen, I'd love to take your money, but I don't think we're a good fit for you. And I'll even say, listen, I've invested in this project that is probably this operator that has deal structure that's probably more what you're looking for. Hey, go talk to them. And then you get into that. Now you get beyond even that. And now you're talking to people who they don't know you. They don't even know you exist. The first thing you do is just let them know you exist. And that's why I go on podcasts. That's why we advertise on Meta. And you just need to get people to know you. Hey, I know these guys exist. Who are they? All right, now I need to get them to like me. And then I need to build up and get them to trust you. And it's been a really challenging time for raising capital since I would say late 2023. 2024 was hard, and we were thinking 2025 was going to be easier, and it's been harder. And it's really because here are the two things that investors don't like in the market. They don't like bad news and they don't like uncertainty. And there's been a lot of bad news around commercial real estate. Anybody who's an active LP investor, a passive investor in commercial real estate, has probably been invested in multifamily over the last 5 years, and they've either got a deal that's not going well, that's not paying distributions, they've got a deal that's had capital calls, or they've got deals that have completely gone south. And then you've got people that maybe were thinking about getting into real estate syndication are now suddenly seeing their friends experience this. So that's kind of what we're dealing with in the market. And then I'm very apolitical, but I was hoping every time we have a change in presidential administration, we tend to see a slowdown in investment activity because people are kind of waiting to see which way the wind's going to blow. And I think we were really kind of hopeful that with a new administration, there'd be at least the certainty would return and people would start to invest again. Right now, I feel like there's still a lot of uncertainty with what's going on politically. And I'm not casting stones. It just, like I said, I'm apolitical, but we've got tariffs, and we've got things, and God love Trump. The man is kind of all over the place. And whether or not he's doing what he's doing is good or bad, it makes it hard to kind of figure out, all right, which way is this going? And that's kind of what some of the challenges we've been dealing with.
I think you answered my next question already, which was, what do passive investors actually want beyond returns? And you did answer that just currently. So let's go on to the next one, which is, what do you believe separates responsible capital raising from just hype?
I look at money as a storehouse of energy that I have expended doing things away from my friends and family. And I think I can't remember, it's Jared Sturm who first said this. I'll give him credit. I first heard him say this at that first commercial real estate conference that I went to. And that, I think, is how I approach investors. I remember that the money that this person may invest with me represents hours of their life that they spent away from their family and friends doing something that was not with them. I'm not saying they didn't like doing it, but sometimes it is. And you want to be a good steward of that money because it's not just money. And I think a lot of capital raisers see dollar signs and they don't think about that. And my mom is invested with us. Some of my best friends in the whole world are invested with me. And I keep that, and I want to take care of an investor's money that I don't know as well as I would take care of my mom's money and my best friend's money.
Do you feel like there's a little bit of a risk when you're dealing with family or friends that you personally know?
Absolutely. Jay Henrich, a very smart investor, once told me, he said, every investor you bring on is a customer service job for the life of that deal. But now take that up a notch and imagine that it's a customer service job with somebody you have to see around the holidays and at Thanksgiving and all that.
So
And
there's
it does, there are times when a deal of ours has struggled, when I've lost sleep, it's because it's a deal that my mom is in or my best friends are in. So it is something you need to consider.
Let's talk about this. What does great communication look like when a deal is not going perfectly?
Great question.
Mhm.
And we try and balance this all the time because, you'd be surprised the number of investors who don't pay attention to what's going on with the syndicated deals they're involved in. I'm invested in a multifamily deal right now that's not going terrible, but they're having to pause distributions. They had a webinar. We invited everyone to a webinar where they're going to explain sort of what was going on. One person showed up, but your question was, how do you communicate, to investors? First of all, is you communicate. Every investor that we have is in my phone book on my phone. And when my phone rings, they all have my phone number, my personal cell phone number. It comes up and it says their name and that they're a Nomad investor. And I will either answer it or it will go to voicemail and I will respond to them within 24 hours. That's one way. I don't ignore their calls. Sometimes I have to deliver bad news. There's no deal that's going to go perfectly. And you need to tell people when things are not going perfectly. Because the longer, we've been accused of being too happy-go-lucky about how our deals are going in the past. And I take that to heart. And that doesn't come from a position of wanting to blow smoke up it comes from that oftentimes we're living in this every day and we're not worried. But we need to realize that person is not living in self-storage every day. And sometimes we need to be realistic about how things are going. And we have had to learn along the way of giving too much information versus not giving enough information. But at the end of the day, the most important thing when dealing with investors who have their money is communication. You need to tell them when things are going bad.
I had a previous guest who created a platform. It's basically Yelp for real estate investors, passive real estate investors. And you can put your GCs on there and you can rate them. And the number one complaint is lack of communication. So it definitely goes hand in hand, exactly what you just
Yeah. We have investors of ours who are invested in multifamily deals that are not going well.
Mhm.
And it's night and day when you have a a deal that's going bad where they're not communicating versus a deal that's going bad where they are communicating. It's just night and day.
You said you want to highlight conversations with forward thinking commercial real estate owners and decision makers. When you talk to owners who are already ahead of the curve, what are the topics that they're focused on right now
In self storage,
in self storage?
I would say we're really paying attention to the amount of new storage that's coming online right now. It's one of the things that we're seeing, one of the things we like that we're seeing. There was a big boom in self storage construction coming out of COVID, and then it has died off significantly with those rise in interest rates. And we like to see that because the fewer new self-storage facilities that are being built, we're seeing a lot of capital start to pile up from groups that want to buy self-storage. That's a great position for us to be in looking ahead, because the less new self-storage product there is and the more demand that there's going to be to buy that product, it's better for us and our investors.
Let's talk to the listeners, talking still about owners who are ahead of the curve. What are they worried about that the average owner is not worried about, or they're ignoring?
I would say insurance costs and tax costs. I mean, that's been a big, the the expense ratio for self-storage has been really advantageous for a long time because it was, in multifamily, it's going to be about 50%, and self-storage is about 35%. And typically, the longer you hold that facility, the lower that expense ratio gets. All of a sudden, you're seeing insurance, the insurance companies nationwide have gotten hit by a lot of big expenditures recently, from hurricanes to fires. And that doesn't stay in that local market. They spread that out across, uh, even if you're in an area where there's no hurricanes, there's no fires, there's no natural events, that insurance company has exposure to fires in California, to hurricanes in Florida, to flooding in North Carolina, and they have raised their insurance. And so we're trying, I think, really smart operators. You get to a certain point where you do what's called captive insurance, where you essentially insure yourself to control those costs. The other thing in self-storage is there's so much automation and technology coming online in storage that suddenly, it's getting a little more expensive. That expense ratio is starting to creep up because suddenly you have all these different technology providers that are essentially going, hey, we want a cut of what you're making. And so you're having to pay attention to that and be very strategic about how much technology you bring in.
That's fantastic, Neil. That brings us right into our next topic, which is systems and tech. So this is the AI Edge podcast, and we treat AI as leverage, not magic. So in your world, where do you see systems and technologies material improve execution in self-storage? And where is it mostly just noise?
Yeah, I can't speak to the operations side on self-storage and AI. I know that every department under our roof, we sit down as a department every week and we talk about AI. And we try to lead with, all right, when you're doing something, ask yourself, how can AI help me do this? I can speak to how we're using AI in investor relations. I can talk about how I'm using it personally. I often, I can't say that I would still sort of call my AI usage a little chaotic because it's just changing so fast. And one of my big projects in 2026 is going to be, all right, how do I rein that in and just like really get that more focused? Right now, I'll use. I really struggle to write. I remember talking to a writing teacher of mine once, and I was like, I can't write, and she was like, bullshit. You can carry on a conversation. You can talk. You can write. But I really struggle getting those thoughts out of my head and onto a page. And how AI has helped me a lot is I can literally just sit there and literally speak into a document, voice to text, what I'm trying to say, what I'm thinking about, the ideas that are coming, and then I can take it into AI and say, all right, give me suggestions. And here's the caveat. Give me suggestions. Don't write this for me. Give me suggestions on how I can improve the clarity, the grammar, and the structure of what I'm trying to say here. And then I can do that. And that's one of the big ways that I'm using AI right now. I also use Gemini a lot. I used to have a master prompt that I would use when I was trying to create a prompt where I would have it interview me about what I was trying to do, like ask me questions about what I'm trying to do, and then it would produce a prompt. Well, now I actually skip a step and I go out and I'll go to Gemini and I'll say, do deep research on how world class investor relations teams in 2025 are communicating with investors, raising capital, whatever. And then I say, go. And it goes away. And you, Lewis, I'm sure you'd not be amazed because you live in this world. It is stunning
Amazing.
what it comes back with. And then I will take that research into Gemini or ChatGPT or whatever, and I'll say, hey, use this research and now create an ultimate investor relations assistant prompt for me. And then I can now go to it and I have a prompt that's focused on investor relations, and I can ask it questions about strategy, about, communicating with investors. And that's some of the ways that I'm leveraging it.
Love it, Neil. Let's go a little bit rapid fire, I guess. How about as far as lead intake or call handling? Are you using AI in any of those types of situations?
We're in a transition period right now. We were doing a lot of meta ads and finding a lot of our leads through there, and which is kind of AI related. I mean, because the meta basically uses AI to feed the ads to people. But we really haven't used AI to make contact with investors. We've talked about it. We've seen some demos from groups that are using it to make the initial qualification call. Because oftentimes what happens when you have a lead, you have somebody fill out an ad about, from a Facebook ad or some sort of lead intake form, and it comes through and now it's in your CRM and you want to contact, we call it speed to lead. You want to contact that person as quickly as possible while it's still fresh in their head why they were interested in that. And there are some groups that are experimenting with AI making that initial call. And I've heard some pretty impressive phone calls. I'm not quite ready to do that yet. It's just this is a high, I'm talking to somebody who I'm going to ask to invest $50 to $500,000 with us. People don't, it's just not quite
There.
that I want their first impression to be, is that I've got an AI that's going to call them. But we're seeing, we use AI a lot when we have a setter that talks to an investor. That call is transcribed. We then run that transcription through AI and have that AI create a collection of call notes for our closer.
Excellent.
So they have some things about how that person thinks about investing that we can pull up. We have experimented with taking some of those conversations into our marketing and said, all right, we know that these kinds of investors this is the kinds of things that the kind of language that they're using to describe their problem. So maybe help me come up with some marketing ideas that have that kind of language in it. So, I mean, there's ways we're doing that, but as far as making initial calls, I don't know, it might work for a plumber,
Right.
but I don't know. I don't think it's going to quite work for syndications yet. We'll see. I could be wrong.
Relationship business. We got to
Very
build
much
those
a relation.
human
100%.
human relationships are important.
Very much so.
Online rentals and frictionless move-ins as far as storage. Is that an option, or is that ability to be able to do that?
It is a huge change in the industry. I mean, it's been ongoing for a long time. Anybody who's been to a self-storage facility has probably seen the rise of kiosks, some managerless facilities where they just show up and there's like a little bank teller thing and you rent a unit that way. In some cases, we're getting away from that because the truth is everybody's got a kiosk in their pocket. And the new really had a shift in the way that the consumers in self-storage are using it. It used to be the average consumer of self-storage would show up at your facility twice, once when they move in, once when they move out. Well, now we're seeing millennials are the largest consumer of self-storage right now. Now, part of that is a sad necessity because they're having trouble buying houses and they're renters, and renters are 25% more likely to use self-storage. But that means that they are living in smaller spaces, and so they are using self-storage as an extension of their closet. And so they need to have a facility that they can access easily. When somebody's looking for self-storage, they're going to chances are they're going to pull up Google on their phone or Google Maps. They're going to search for self storage and they're going to call the first facility that pops up near to them. And whoever answers the phone is oftentimes the one who's going to get the tenant, the rental. And then, millennials, they don't like talking to people on the phone. And if you don't have a way to rent a unit online on someone's phone, you're falling way behind. We're in the process of acquiring a mom and pop facility where the owner has no website, no electronic gate. He literally shows up at 5 a.m. Monday through Friday, unlocks the gate, opens it, and then sits in the office all day long. You have to pay cash. No credit, doesn't accept credit cards, and that's how he's been doing business for 20 years.
Those are the ones that we buy.
We love it. Trust me. Like we're probably having to overpay for this one a little bit because we can see the opportunity there. And so, now we're seeing that some of the technology we're seeing is, Wi-Fi locks. There's some locks where it's literally, you don't even have a lock on the unit. I think it's a little bit, I think it's a little expensive and it's just too much technology and it gets expensive and they fail. But I've seen some demos from DaVinci where it's literally a standard lock, but the person just can literally rent a unit and you've got a lock sitting in the unlocked unit and they literally can go and it's got a PIN code on the back. They scan it with a QR code and it gives them the code for the lock and they can do that. So that's really kind of where things are going. Storage needs to be careful to not what if every door had its own master lock and, electronic lock and they would just go and they just hit a button on their phone and it unlocks. That sounds great.
Yeah, right.
But you start to it gets a lot more expensive, a lot more technology. It means it breaks more often and it gets complicated and you start going down a rabbit hole. So you got to be careful. You got to keep it simple.
How about as far as dynamic pricing and revenue management?
Very much so. We really went through a struggle. A lot of really smart operators are doing dynamic pricing where literally if somebody comes in and rents a 10 by 10, the next person could come in 5 minutes behind them renting this exact same type of unit and they're going to see a higher price, just like the airlines. We experimented for a while with price locks. Say, hey, tenants are getting really frustrated with price increases. And the reality is that unless someone's willing to pay up front, we can't do that. I'm sorry. It's just the way of the market. It's the way of the world. But there's been some chatter in the industry around sort of rent control in storage. And a lot of the self-storage associations nationwide, that's been one of the prime focuses that they've had to focus on legislatively is fighting those rent control laws. You really do need to have some sort of dynamic pricing. You need to know what units are in demand in your market and what the competitor on the street is charging for it. And it's just good business. Oftentimes, when you're in occupancy management mode, your prices are going to be lower. You're trying to get people in the door because that unit, an empty unit, is costing you a certain amount of money every month. And are you better off letting that just sit there and burn your cash? Or would you be happier having somebody in there that's at least making $1 a month on it until you get to a point where you're full and now you can start raising rates and now you're in revenue?
Neil, somebody owns a construction company. Last one, construction project tracking for conversions. Do you see AI being able to do that?
That's a good question. I'm not equipped to answer that question, Lewis. I'm not on the construction side. We have construction people that'd be better equipped to answer that question.
If you had to choose two systems that you would never run without again, what would they be?
HubSpot we use for our CRM, our investor communication. It's where we keep notes about investors, is how we email them, how we send out mass blasts. Before that, we were using Google Sheets and Gmail.
Excellent. When you zoom out, what are you building for? What does freedom mean to you now compared to what it did when you first started?
Freedom now for me means being able to go where I want, when I want, with the people I love, and dying with a collection of photos of the things I've done with the people that I love rather than a bunch of things.
I believe life is memories, right? It's about magic moments, about creating those memories. That's what's important to me.
Yeah, I can't tell you a gift that I got on my 11th birthday or for Christmas when I was 11, but I can tell you some of the memories I have from our first family's trip to Europe.
That's beautiful. How do you want to structure your life and your time as your portfolio grows?
Great question. I struggle to delegate, Lewis. That's one of the things. I'm now the director of investor relations. It's one of the things I need to get better at is delegating to other members of our team. And I also need to learn to do that just in my life and my personal life. And I recently I don't quite have the financial means to take this on yet, but I would love to have a personal assistant that handles some of my personal life, like I now have a bit of some assistant, in under the Nomad roof. Yeah, I just think that my favorite book, and you're probably going to ask this question, so I'm going to jump in front of you. One of my favorite books is a book called Who Not How, and the basic premise of the book is rather than spending your time trying to figure out how to do something, find somebody who really knows how to do it and gets joy from doing it, and just pay them to do it.
And hire them.
Hire them, and then go on and focus on what it is that brings you joy and brings you higher, um, higher earning potential.
Percent. Let's land this plane, Neil. What does success look like 10 years from now?
I would like to be. I don't want to stop working at Nomad. I love what I do. I don't envision that I will ever just stop working and go live on a beach somewhere and sip Mai Tais. I think that's a fast lane to the grave. I would like to be. We're called Nomad Capital for a reason. Our goal is to build a tribe of nomads for both our investors, employees, and their families.
That's great.
And I would love to be able to go and spend 3 months in, um, someplace that interests me, and I don't know where that is. I once spent a month in Australia, and it was fantastic getting to be in a foreign country for an extended period of time where you really got to kind of stop feeling like a tourist. I'd love to be able to do that and, go to South America for a period, go to Africa, go to Europe, go to Australia, go to Asia. That would be my dream.
That's beautiful. I have a colleague, a friend, mentor, coach. They used to ask, his name was Kyle, and they would ask Kyle, where are you going? He's like, I'm going to the Bahamas. He lives in Jacksonville, Florida. He had a beautiful boat. He's going to the Bahamas. When are you coming back? He's like, I'm not sure. He goes, what do you mean you're not sure? He goes, I don't know. It could be 2 weeks, could be 2 months, it could be 2 years. When I'm done, that's when I'll be back. I mean, that to me is the ultimate goal. That
Yeah.
is freedom. The ultimate goal for me has always been the ultimate is freedom.
My business partner, Eric Hemingway, sadly lost his wife October of 2024, glioblastoma. It was a huge blow to his family, and our whole company. We're a very close-knit family. And he has 6 kids, but his youngest son is 16. And this January, he and his son are going to New Zealand
Amazing.
for 3 months.
Wow.
And going to have just a great life reset adventure.
That's
And
beautiful.
I'm proud of them and excited for them and a little envious.
That's a blessing. Neil, thanks again for coming on and walking us through what Pivot really looks like from a long career in defense contracting to real estate through active rentals and into self-storage syndications with a discipline and clarity that most people skip. For listeners who want to follow your work, connect with you, or learn more about Nomad Capital, where's the best place to find you online?
Well, if you're shy, just go to nomadcapital.us and look at our website and see what it is that we do. But if you're feeling a little more bold and you want to chat, feel free to shoot me an email at Neil, Neil at nomadcapital.us. I'm happy to chat with anybody.
Love that. We'll drop those links and tags in the show notes for the operators, investors, busy professionals who follow your work, especially the people exploring self-storage as a serious lane. Thank you, Neil. You brought a grounded view for passive investing, not a dream, but a system. And you shared the realities of what it takes to raise capital responsibly, operating assets well, and building freedom without burning out. This has been the AI Edge podcast. If you got value from this episode, send it to another operator or professional who's thinking about making their own pivot and wants real example of how to build long-term leverage through disciplined commercial real estate. We'll see you on the next episode. Thank you, Neil.
Thanks for having me, Lewis. It's been a pleasure.